parentage demands attention. So does the quick build-up in size and performance of this fund house. Religare Mutual Fund may be the new kid on the block, but it hasn't taken too long to establish a strong positioning and formidable penetration amongst retail investors. Backed by a solid investment team, a nationwide distribution network, and an unapologetic ambition of becoming big, this fund house has a mission to accomplish.
It's a young mutual fund, yet everybody has noticed it just on performance. I'm in conversation with the leaders at Religare Mutual Fund, Saurabh Nanavati and Vetri Subramaniam. Gentlemen, thank you very much for joining me for this special. Saurabh, I'll start with you. It's been a great start to the fund house because of performance, but the stakes are getting higher. You have to sustain the momentum of performance, right?
Absolutely. No, I guess we are going to complete 3 years after the Lotus takeover in October 2008, November 2008, and a satisfying journey at this point of time. But having said that, I think we were fairly clear when we started this business that we need to focus on the manufacturing aspect. People will come back, clients will come back if there's fund performance. A common example which I always keep on saying is you can go to a restaurant for because it's new, because of a great locale, but you'll go back again the second time only if the food is good. And I think we need to focus on that food, and that food is fund management for our business. What we have done when we started off is we have an institutionalized process. So both in equity and debt, we have our own proprietary process which we follow. We have very large teams both in equity and debt, and we invested in it from day one. And I think over the last 3 years, the performance is paying off. Once you have this process in place, you're not dependent on a staff fund manager. You can ensure repeatability of the process and the performance. And you then become answerable. I think the key from our perspective is being answerable on every decision we take.
Took over Lotus Mutual Fund where investors were fairly dejected. How did you manage that part? Did you start afresh, or did you really try to bring those investors on board as well with you?
Well, Lotus, when we took over Lotus in October, November, I guess there was a lot of strife in the system at that point of time across multiple fund houses, across the whole industry.
Right.
We were on the verge of launching our own mutual fund. So we had got our licenses in September 2008, and the first Religare mutual fund product was going to be launched in November 2008. I think what Lotus gave us was a platform because they had funds which were running for a 1-2 year period. A very important point I would like to point out at this point of time is we made good all the losses of investors, especially in the fixed maturity plans. So the investors did not go back dejected to that extent. Whatever they had been promised, they got it. And then the task on us was basically to start afresh. Bring in all these systems and processes in place so that we do not have a repeat of whatever would have happened. So all I can say is I think investors have not gone back dejected. They have got their promised returns, and I think they have stayed with us. So today we have over 250,000 retail investors, and we are again one of the few fund houses in the last 3 years where retail investors have grown in numbers when we actually see at the industry level retail folios coming down. And I'm sure they can notice the difference.
The retail breadth is also leveraged from the group's distribution, isn't it? The financial services business as such. And a lot of it is also coming from your overseas business. So elaborate, I mean, where is that going to go and how will you continue to leverage it?
Okay, let me, so how is our assets under management at this point of time broken up? We have close to 12,000 crores in assets under management at this point of time in local mutual fund business in India. We have another 250 crores in our portfolio management services business. And now we are almost going to touch close to 4,000 crores in our offshore business. And that's something, these are offshore advisory mandates, both in equity and debt, which foreign investors, foreign retail investors have invested in these same schemes which are being managed in India with us. I think all these three fundamentally, we will be disappointed if all these three don't double in size in the next 2 years. The aspiration is to grow all of them. I think the aspiration of the business of Religare as a group, as a whole, is to build, a scale business. In whichever businesses we are in, we want to build scale. We want to offer all the products which are there in the financial services space, and there should not be any compromise on the manufacturing platforms. So I think all these three will build up.
So if you're talking scale, is vision to really grow in size? There is a quest to get to the top on AUM?
Not at the cost of performance, clearly. So I think performance is the primary objective. I think if performance comes, AUM is an outcome. I think we have been very clear on that. So today when we look at our own sales teams internally, they are basically judged on the number of new clients they get rather than the AUM they get. So when we go back and when I meet my sales guys, and if they say that, I've got this one client with $100 million, I would much rather be happy with 5 clients giving me $1 million each, because once we perform, I think then, why won't the client come back and give me more money to manage?
Right.
So I think, if the performance is there, AUM will be an outcome. Having said that, we are a young, energetic, aggressive group. We want scale. We want to enter into different geographies. We want to change the landscape. So when retail in India was getting tough, we managed to get 10,000 retail Japanese investors to invest in our mid and small cap fund, which is now over 1,000 crores in Japan. And those are the things which we are trying to do.
So you don't miss having a foreign partner in the fund?
At a later point of time, we are open. But having said that, at this point of time, I think we've got a team which has come together. We've all had experience in foreign companies, the way they work, and we have tried to put in place all those systems and processes of whatever we would have learned from our prior experience. So to that extent, no, I don't think we are missing a foreign partner in that sense, and it's just giving us the freedom to go out alone and go in different countries and say that we are a homegrown asset manager, and in these kind of times, I think that turns out to be a big plus.
Managed to find an outstanding equity head. So what does he do to bring that magical charm to equity funds? 3-year performance, 4 funds in the top quartile. That's a pretty good going.
Yeah, I mean, the fact is that I managed to get him to join us at that point of time, and I'm happy about it, because I think both of us, from a thinking perspective, we were fairly clear that if this needs to sustain over a longer period of time, it needs to be a robust process, it needs to be a repeatable process, and investing is all about discipline. So we've worked hard to put the equity proprietary framework in place, the debt proprietary framework in place, and I think we are running a fairly large investment team, which when the performance comes, they all become happy and they perform even better. It's a vicious cycle.
Okay, and a good vicious cycle to be in. Let's get to the schemes per se. So I'll start with Religare Contra. 5-star rated fund by Value Research, has a contrarian approach. Do you worry sometimes that if there is a sustained bull run, that contrarian approach may not work, Vetri?
I mean, it's always a challenge, and this is a fund which, based on our own experience and the way that we run it, will always tend to do far better in a market which is more sort of value oriented. And as valuations go from very cheap to average levels or even moderately overpriced, it tends to be very strong in terms of performance. But in an out and out growth oriented market, as opposed to just a bull market, it is a strategy which will sort of struggle a bit relative to the market. But the way I look at this fund, or for that matter any of our funds, is that each fund has a strategy which will do slightly better in a certain part of the market cycle. And what's important is that as long as you stay true to that mandate, the outperformance that you generate during the favorable market environment more or less makes up for how you might do in a more challenging environment. So I think we're quite comfortable with that. And also, I think one of the things that people look at Contra, they always look at it from the point of view of, at every point of time you have to buy stocks which are contrarian. And, I always halt them at that point and say that really, when it comes to selling stocks, this fund is no different from any other fund. If we were good enough to get into a stock very early, there is no reason for us to sell it just because it's become popular. We sell any stock from this fund when that fund no longer merits an investment, whether it be in this portfolio or any other portfolio. So as long as you follow that rule, you're not unnecessarily selling your winners too early. And that, I think, is really the trick in managing the portfolio. If you do that, then I think you can be consistent across most market cycles. But yes, a big chunk of your outperformance will be generated when you're in that low valuation environment.
Religare tax plan, another one, award-winning fund as well. What works there? And I think importantly, I'd like to ask you, what will you do once DTC is implemented? What's the thought process? It's doing extremely well, but fresh monies will probably stop because ELSS is the first step for most people to get into mutual funds, which is going to now go. But for the fund itself, what would the plans be?
Well, to take your first question, I think as far as the strategy is concerned on the tax plan, it's actually a very simple strategy, which is to say that, we actually run this fund on the basis that we've got money which is going to stay with us for 3 years. So, what can we do differently in terms of being patient with a large set of holdings in this fund and then give them the benefit of time to be able to perform. We run it as a diversified fund. We really don't take very extreme bets anywhere. We've got a reasonably large allocation to the mid and small cap space because we think that 3-year window works quite well for them. So it's been, in that sense, I would say, a very simple strategy, a bit growth oriented, and obviously with large dollops of patience thrown in as well. I don't really see the DTC going away as being a challenge. I think, for us, really the challenge now is more to say that can we take the strategy and put it on a regular fund where we don't have the benefit of that 3-year lockup money. I don't think that challenge is really insurmountable, and in a way the 3-year lockup means that there is a large number of investors within the marketplace today who don't invest in that fund because of the lockup. So we can transport the strategy into another fund or the same fund depending on how the rules and regulations play out, and then it becomes a strategy which would be acceptable to investors who don't want to get locked in for 3 years. So I actually think it's a fungible strategy, and it can be taken to market in a more broader way going ahead.
So I'm hearing a lot of value and growth approach, and if you come to the mid and small cap fund, it's again a bottoms up approach. So is that essentially the way you'd like to go, never buy expensive at all? Even, like a consumer story today, already expensive, but then there is a whole market out there which says a 30-35p is not expensive when you look at India.
Well, actually, I think the thing about the platform that we've set up is that we've tried to make sure that, we are diverse, not just in terms of the strategies that we run, but in terms of the people that we have, and therefore the way that the strategies can actually get executed. And if you actually look at the mid and small cap fund, it's a complete counterpoint to the contra fund, for example, which is extremely value driven in its approach. The mid and small cap is actually an out and out growth oriented fund.
Okay.
So, the two funds have very little in common in that sense. I think it's just the fact that we've got a platform both in terms of the way that we go about the bottom-up stock picking, which is based on our own proprietary framework, and the way that we construct the eventual portfolios for each fund, where we pay attention to the levers that we think need to be used to create the portfolios, whether they're more growth oriented, they're more value oriented, whether they use asset allocation, whether they use only bottom-up stock selection, don't look at the top-down sector allocation. So for example, in the mid and small cap fund, we're so much driven by bottom-up stock picking that we don't really apply a very significant top-down view on that portfolio. So there is obviously a contribution that sector allocation makes to the alpha, but really it's a residual. It's driven completely by our bottom-up stock picking for that particular fund, and that's very different from some of the other funds that we run.
There's a lot which needs to still come together on macroeconomic factors, isn't it?
There are some bubbles waiting to burst in the global scenario.
Let me come to the overall scenario. Equity markets, Vetri, where are they headed? 3 years, what kind of returns can an investor expect from equities per se?
I think we're still in a bit of a challenging environment. Having said that, compared to the level of cautiousness we had a year ago when valuations were clearly outside the comfort zone, what gives us a larger amount of confidence today is that the valuations are no longer unreasonable. In fact, I would say in a large cross-section of the market, the valuations are now quite reasonable, and in some areas it's almost reaching distress levels. Obviously, you've also got some parts of the market which are still trading at fairly expensive valuations, but there's a lot more opportunity for stock picking today than there was 18 months ago or 12 months ago. And I think, from that perspective, really the way we look at it, at the end of the day, your returns over a 3-year, 5-year, or for that matter, 10-year period are a function of the valuations at which you enter the market. And I think today, given where valuations are, we can be far more optimistic that your returns over a 3 to 5 year period, I think can get up to that 15% plus kind of a mark. And if you can add some alpha on top of that, then your returns obviously improve. So I think we're in a reasonably good environment for stock picking. Valuations are on your side. But yes, the macro environment is still extremely challenging. So, when we can really start to see the economy gather some momentum and that get reflected in the stock market is anybody's guess. It could be 6 months, it could be 1 year, it could be longer. But I would really say that, this is the time to take a constructive approach towards equities because the valuations are in your favor, and use this as an opportunity to increase your allocation to equities. Be patient, do it over 12 months, 18 months, pick your time window, but be constructive.
Saurabh, what do you see as the big challenges? I mean, macro factors are the ones which are looking a little shaky, both internationally, hook or by crook. There's US trying to avert a recession, and you also have Europe trying to avert a sovereign default. Domestically, we have our own challenges, and there's a lot which needs to still come together on macroeconomic factors, isn't it?
Yeah, I guess there are some bubbles waiting to burst in the global scenario. When this happens, whether it happens in the next 1 month, 3 months, 6 months, difficult to put a finger to it. But yes, I guess the consensus feeling in the investing community is that it has to burst at some point of time, and then that period, it could be a short period, it could be a protracted long period. It could become very painful from an investor's perspective. From my own perspective, if honestly I look at it, amongst all the asset classes, I think debt presents a phenomenal opportunity in India at this point of time with these kind of high interest rates.
Right.
When I go overseas and I look at equivalent rated bonds in the global scenario, I think we are mispriced by almost 150 to 200 basis points. And that's purely because India, the Indian currency is not convertible. We have all these restrictions on foreign money to invest in debt. The day it goes off, those spreads can contract. So short time frame at this point of time for investors, when you're getting 9.5%, 10%, I think we are clearly seeing that shift right now, right? Even in retail investor portfolios where they are migrating from equities to actually bank fixed deposits. That number has actually gone up from a 50% holding to almost 59% as per the last RBI thing. So that presents an opportunity. I think equities, as Vetri rightly said, it's a 3-year process. You need to be patient and look for a 3 to 5 year. Over that period, yes, then you will definitely get your return, which will commensurate with the risk you take. If you have a shorter time frame, at this point of time, Indian debt is a very good option.
Vetri, there is an opinion that the worst is not behind us, and 2012, 2013 could be really a year to reckon with on the downside when it comes to equity markets. Is that a view that you share?
Well, it's an unpredictable world that we live in. So, I don't know whether it'll be 12 or 13. I think clearly from the equity market point of view, or for that matter from the point of view of financial markets, the big unknown is the resolution of this entire sovereign debt issue in Europe. And a disorderly outcome over there, I think, will have a negative reaction across all financial markets and all asset classes, because you'll most probably see a freezing up of liquidity like you did in 2008. And this is obviously far bigger than what happened in 2008. So I think the risk of that disorderly outcome is obviously there, in everybody's mind. Will it play out? When will it play out is really the unknown. I think as far as the Indian equity markets are concerned, our bigger problem, in my opinion, is really that we have homegrown problems. Because I think we've taken the India growth story to be an abstract noun, which it isn't. It's actually a verb, and it requires actions. And we are not seeing the kind of actions that are required at a policy level in the investment cycle to really keep that structural story in place and ensure that we can get the high rates of growth that we actually need. So I think there are a lot of homegrown challenges that we need to address. The good news is that it is within our capacity to address those issues. If we can address those issues, I think we can have a medium-term outcome which can look far superior to the argument for equities perhaps in most other parts of the world. But we need to take decisive action if we want to get those kind of outcomes.
All right, a lot of heavy talk, so let's now get into something lighter. I understood both the debt and the equity market outlook from you, but so, I mean, within office, what's the kind of atmosphere you have? Is he a tough boss?
Well, I think he's a reasonable boss,
okay.
Which is how you should like your boss
on
to be.
national TV, you ain't going to criticize him, right? Okay. And what are the things that you do beyond work? Saurabh?
No, just go back home and play with kids.
Okay.
I have two young sons, 8 and 5 years old, and I love being with them and being with family. So
yeah, that's a nice way to unwind. And what would you be doing if you weren't doing this? Have you ever thought of an alternate career?
Well, at this point of time, I desperately, want to get into something which is related to manufacturing or agriculture, to be honest. That's the core activity. You can't basically, disregard that. Somewhere in this financial jungle, I think we keep disregarding that, and we want to play around with our Excel sheets. I think that's something which they do, which is a core activity.
So get your hands dirty.
And get your hands dirty. I just love that.
What are you passionate about, Vetri, other than stocks?
Well, actually, stocks is like walking in every day and having a different puzzle to solve. So I wouldn't trade this job, frankly, for anything else in the world.
I'm not even asking you that, so what else would you do?
Well, as far as free time is concerned, I like to spend a fair deal of it, get the opportunity to spend a lot of time outside Bombay in the greenery, in the countryside. So that's nice break, being away from Bombay in the greenery, and enjoy running quite a bit. So I have a nice routine 6 months of the year preparing for the Mumbai Marathon every year. So that
really?
keeps me occupied. So yeah, so keep various things going outside of stocks. And as far as stocks are concerned, I'm very clear. Stocks are something you think about between maybe 8 in the morning to 7 in the evening, and after that you stop thinking about stocks. That's the only way to do it. If you're going to watch TV all night to figure out what's happening around the world, then you're not going to have a very happy life. You're not going to have a very nice time at the stock market.
No wonder our TRPs beyond 7 don't do very well. Saurabh, Vetri, thank you very much, gentlemen, for being on the show. Thanks.
Thank you.
Thanks, man.